To another King's Crowd Investment Roundtable. This week we have some great content we're going to be talking about, both looking at an interesting trend in terms of failed raises on StartEngine, and then going into our chart of the week this week put together by Leia, which is going to look at the top 5 platforms in terms of the King's Crowd ratings. So are we seeing trends in terms of deal quality and not just quantity across some of those platforms? I'm joined today by Leia, who is back from her travel, King's Crowd on the road. Welcome back, Leia. And Scott Katoon over in the other screen there. Let's jump into our first topic. We were running some of the data over the past month, and we noticed that StartEngine raises that closed essentially since the beginning of February we're seeing a really high failure rate compared to what we're normally used to seeing. So when I say a failure rate, it's basically a company has to hit its minimum fundraising goal when they set a target. Otherwise, all the funds get returned to investors. And over the past 25 raises that have closed on StartEngine, we noticed that 17 of those were actually not funded. Now, I will pull up my screen and can show that real quick, but Leia, what are some of our takeaways? Do we see anything in the data or the trends about why that might be happening?
The main reason that we had identified is that StartEngine seems to have raised its minimum to $124,000. So it seems that companies, if they cannot meet that threshold, will simply not be able to actually close their round and take the money for themselves. This is a very interesting move because this is the only company, the only platform that seems, at least from what we've seen, to be able to do that in the market, which is kind of has positive side for investors, negative side for funders. So when I say negative for funder, well, simply if they raise on StartEngine, it becomes way more difficult for them to actually raising money. We've seen in one of the latest chart of the week that the median amount raised online globally is around $100,000 and on StartEngine is around $200,000. So it's kind of normal that we see that about 30% of companies just cannot close a raise on StartEngine. The problem here is that when you start a Reg CF, you have to pay different lawyer costs. You have to spend time filing SEC requirements. So you have to really invest a lot of time and money into starting a Reg CF file. So for companies that are maybe smaller, that cannot really bring $124,000 on their own without using the StartEngine platform, it may be not a good idea for them to go on StartEngine. They may want to go on platforms that have a lower minimum. The good thing here for investors is that indeed, when you invest in a company that is not even raising $100,000, this company is going to have less fuel to grow, and it may hurt if the growth of the company, then the potential return that you will have on your investment. So that can be in some way protecting investors. This is an interesting move. I don't know if Scott has seen it coming.
I mean, you can definitely tell that there's changes that have had to be in the works. I mean, I think we've talked about this on at least one prior episode about just the amount of companies that are not being fully funded or are raising slightly less funds per campaign. I think that we've also talked. There was a chart of the week, maybe end of 2024, showing sort of 70% of the money that's raised kind of ends up in 10% of the company's hands. There's all kinds of, I would say, kind of dead landing deals that are neither venture backed nor hugely unique. And the founder doesn't have a huge network or background, and they come on here and they raise. And I think a lot of times maybe the platforms bite up too much that they can chew. They try to kind of make promises that they can do X, Y, Z, and I think they're probably have learned their lesson on that. And not giving you breaking news here, but the house kind of has to always win. And for the platform, they need to have companies coming on that are raising enough money that it makes sense that they employ the staff they employ to maintain this, and that every time they push out a new deal on their platform, they're sort of selling a fraction of their audience, attention. So if there's other deals that they could fund, the same investors would put more money in per deal versus splintering off a little bit in these just to keep them. I just think it's it's a net loss for the platforms. And, this is something that I think Wefunder has done really, really well, not StartEngine here, but I'm curious you guys' thoughts to spin this back on you. I know why platforms maybe don't want to do this because their whole business is like, like any other business, like how do I get you in this car today? But I don't understand companies that don't do test the waters for everything first. Like I would literally I would have this conversation amongst my team and say, hey, do we want to raise money this way? I would send out feelers to all of my customers and see if there was a lot of interest. And then I would reach out to a platform who wants to have me or issuance or whoever and say, hey, we want to basically do a test the waters to determine how much we're going to have, and then we'll go forward with any of this stuff. I feel like that's such a brilliant idea that is mostly utilized by large companies, large startup companies like Substack and Mercury and others who've filled in a day, but like actually might be a really good practice for like every company. I'm curious your thoughts.
Yeah, it's very timely that you bring that up, Scott. So I'm actually doing an analysis right now for next week's chart of the week.
Love when I nail it.
Teed that up perfectly. Look at that. But going to be looking at some of the testing the waters trends, because a couple of things, right, that tends to happen is once you launch testing the waters, yes, you get some of those initial interest and commitments to figure out what the interest is. But there's always a drop off when you convert. And there's going to be some percentage of investors that don't get the email, it goes to spam, they forget, whatever the reason is, they decide that, hey, yeah, I'm going to put that I'll invest $10,000, but when I actually decide to invest, I only have $500 in my bank account, so that's what I'm going to send you, right?
Well, yeah, so, you got to use the birthday party rules. Like you invite all your friends. If half show up, you're pretty cool. If you get like a third of your friends, there's nothing to be ashamed about. It's the sub 30 where you really got to look yourself in the mirror.
Yeah, and so I'm curious to think what Leah thinks as well on that, but just to kind of tie off some of the other thinking around that, right? I think there are definitely benefits to testing the waters where, like you said, you get some of that interest and some of that feedback. You can go out and you can start talking about it before you've sunk in a lot of your initial time. And I think just from a platform strategy, if it is what StartEngine is actually doing here, where they're imposing a higher minimum for like just their own, it's not because of regulations say they have to do it or anything else, but they're like, hey, we decide you're going to do this. They're kind of looking for that issuer that is maybe more serious, right? Where it's not just, oh yeah, I'll take 25K if we can get it, but if not, they want to really focus their energy on the types of issuers that may be shooting for the higher amounts, where it's 80-20 principle, right? Just trying to focus your time where you're going to get the most return.
Do you, Leah, you're analyzing a bunch of these deals. Brian, obviously you're sitting back looking at this every day. Do you feel like this is a bit of a tipping point here where like we're not just talking about money, we're not just talking about a platform trying to like be more efficient, but actually like an entire market sort of raising its hand and kind of saying, hey, I love to support local, and I, any deal that comes up, like I would look at it if I know them. But like I'm kind of tired of like the moonshot, dream shot stuff, and I would like to have deals come to the table that are a little bit more advanced for me, because this is very anecdotal. And Brian, this is, I guess, homework, right? But like Dealmaker, I've been on this whole pursuit chasing Dealmaker, not just Dealmaker, but all of them, but chasing the advertising models that these guys are using. And time again, I see Dealmaker deals that, whether we think they're good investments or not, or how they stack up at King's Crowd, is a different story, but they are more mature. I'm not saying that the pricing is like great or anything, but these are like founders that have, in a lot of cases, are in their 40s, not their 20s. I see a lot of like post revenue. I see a lot of raises that are in the like 5 to 20 million range, not 500,000. And they seem to be getting traction, and enough that they're spending what would appear to be a significant amount of capital in advertising efforts. So I'm just curious what you guys think of this, because I'm looking at this thing and by the way, if you can't tell by my tone, very favorably. I think it's a nice opportunity to start moving a little bit more mature relative to the offerings, and putting pressure on investors to pick more shrewdly, but platforms to also limit what goes on their platform.
I do see this favorably, because it's good actually for investors to understand when they are on the one platform, what are the type of deals they're going to find. If you go on Wefunder, you're going to have everything from big startups to small mom and pop shop. Maybe you know that if you're on StartEngine, you're only going to have these deals that are going to raise more money. And at least investors know what the StartEngine brand means for them and what they should be expecting. I personally, I don't really invest in small companies for the reason that when I invest into equity, I want that equity to get a lot of value by the time it exists. I will invest in small businesses if they're raising debt or revenue share deals. I think that, and it's my philosophy. When you invest into equity, it's way better to have a company that actually is going to be able to grow and have a good exit opportunity. It's hard for me to invest in one whiskey brand. There's just like what 10 a week that we find on equity crowdfunding. And I understand that some of them would just not raise money, they would not grow enough, and they would just not generate a return. So I don't see this as a bad thing. It's an interesting move. And for investors that still want to back smaller companies, companies that will rate less, smaller rounds, and maybe only want a 2 to 3x return on their equity, they can still go on platforms like Wefunder that accept just a way larger variety of deals.
Yeah, it's, I think, somewhat, it'll be interesting to see. Just it's their own marketing strategy on the platform side, right? We've been around the industry long enough now where the platforms that maybe went out there as just, hey, we're an equity crowdfunding marketplace, that's such a broad thing that doesn't appeal to anyone, right? But if you start having more specific messaging, and maybe WeFunder still is like, hey, you can come here, and whether you're a small business, you're a YC backed venture startup, we'll take you. But other people seem to be focusing more on their niche and able to differentiate themselves. So I think, this is actually a great lead in to the chart of the week. And I think we can transition to that, because what we are looking at with this week's chart of the week was we were looking at, does deal quality, using the King's Crowd rating star, basically 1 through 5 stars, how we rate every single deal, how does that vary across the deals across the top 5 platforms? So I think this is, almost another great way to look at how some of these platforms are perhaps differentiating themselves. So Leia, why don't you put together this week's chart of the week? Why don't you give us a quick overview of just some of your quick takeaways that what you found when you were looking into this?
Yes, we wanted to try to understand whether some platform had higher quality deals than others. The quick takeaway here is that we see that Republic is still at the top. We never really did that analysis from a data perspective, but as analysts, we always felt like Republic deals overall were pretty high quality. And even if there has been somehow at some point a slowdown in the last couple of years in the number of Republic deals, right now they're at the same level of as Dealmaker. We in 2024 we rated about 64, 65 deals on each Dealmaker, and sorry, I said something. Okay, Republic is more or less at the same level as Dealmaker in terms of deals. Each had we rated about 64 to 65 deals for each platform in 2024. But we see that there is a rating difference between these two platforms. For me, the main explanation here is that, well, not only Republic is very selective, but I'm sure that Dealmaker is selective as well. As Scott was saying, they usually are more mature companies with higher revenues. In a lot of cases, Dealmaker do not show clearly the evaluation of the companies on its race pages, which means that we have to calculate it on our side. And unfortunately, a lot of time these companies are clearly overvalued. Even when they show their valuation, we often have valuations that go in there on 20x, 30x plus multiples, companies that are raised over $100 million. Sometimes it's even way more outrageous than that. And to me, that's one of the reasons why, on average, the deals just rate a little bit lower than Republic, StartEngine, Wefunder. Another point that is very interesting is that here we're looking at the 5 platforms with the highest number of deals in 2024. And 4 of them, Dealmaker, StartEngine, Wefunder, and Republic, all have a median rating which is above 3, 3 being the average. So that means that these 4 platforms are overall offering pretty good quality deals. When it comes to NetCapital, it seems like NetCapital is definitely kind of lower in terms of rating versus these 4 platforms. Maybe you have more insights into how they select company. I just know that it doesn't always really fit our criteria, and we don't really filter them as much. Now, if we find a good company, we see that they still have a couple of companies that are rating over 4. We're definitely happy to feature them. A last thing that surprised me is that WeFounder's rating median is higher than StartEngine. I was surprised because they are typically a little bit more companies on Wefunder, and as we say, sometime earlier stage than on StartEngine. But what we see when we look at the data is that StartEngine also has a wide range of companies that do not rate as well, and Wefunder is doing slightly better with our algorithm than StartEngine.
Real quick question on that, Leah. So did this chart look at all Reg CF offerings, or did it also look at just equity versus debt? Did we include debt and revenue share in that?
It looked at just equity, Reg CF, and Reg A that started raising in 2024.
Got it. So it could also be, Wefunder does tend to have a lot of deals, but they also have on the Main Street kind of small business side, they may have more revenue share debt deals as well. So perhaps, Wefunder just is stronger on the equity side. It could be, but so yeah, looking at this, Scott, I'm curious, what are your takeaways for investors, for even founders, maybe if you're trying to look at this and decide, which platform do I want to raise capital on? What comes to mind?
Yeah, I mean, look, I think I've gone on the record on saying this before. I think the future of this whole space, whether you're just talking about startups in this, or you want to get into different asset classes, credit, I think Leah talked about earlier. I don't think we're like in the business of platform. We, KingsCrowd is, but like as far as investors, like I wouldn't be focused on platforms so much other than maybe the, Yield Street and stuff that is very specifically, real estate or credit or whatever. All of these platforms are basically just in a race to try to find the very best deal, and the power pendulum is sort of swinging kind of back and forth between the platform and the issuer company. It feels like momentum has it heading in the direction of the issuer actually, and where the platforms are sort of at a race to the floor as to who can get the most of them. That's where I think things are going. But I think right now, my general temperature, getting emails from just about every newsletter person you can think of, and obviously working closely with you guys and Republic and others, like I don't think it's close. I think Wefunder does the best job, bar none, not even really a close second, even though this chart would make you think differently, with regard to getting mid-stage venture-backed startups, not small businesses masquerading as a venture, like straight up. I think they do the best. I think that team does so much with so little. Their connection to YC is obviously a huge advantage. The fund structure they have set up with that is a huge advantage. That said, they are certainly at risk. There's not a shortage of shit posters on Johnny Price's LinkedIn posts pulling out that like there's a lot of deals coming through here that people will not make money on. And I think that's kind of negligence on the shit posters part, because they're not understanding the risk profile of venture in general. But like my point there is that they do open themselves up a little bit, because they are taking venture-backed companies that have much higher valuations, but they are maybe a little further along, a little more secure. And I personally would rather invest in them if I was just looking for startups. If I was looking for companies that Leah has covered for years here now, you start getting into like medtech, robotics, energy. I don't think that Wefunder is the place for that. I think that you'd probably most often find it on StartEngine, some Republic, although Republic to me has always felt very consumer tech. If you're looking for consumer tech, I feel like that's been a place that's kind of their sweet spot. And Dealmaker is the newest, most aggressive player in the space. And it feels like they're chasing after the next, like, let me put it this way. I think they learned a lot from Boxable, but leave it at that. I think there's a lot of opportunity here, but for investors, you really should be looking at deal by deal and not platform by platform. That's just my opinion.
Yeah. And that's a great plug for KingsCrowd, because when you come to the KingsCrowd platform as an investor, you can sort just by, hey, show me the top rated deals in this industry that I'm interested in, or under this valuation or in this range. And regardless of platform, we show it to you, because I think right now, I forget the exact number. Last time I looked, there was still more than 90 plus registered funding portals that basically you could do an offering on. Now, you obviously know as an investor, if you look at the market at all, that the vast majority of those have no offerings that are live, or, one or two offerings. Now, that being said, every now and then we do see some interesting deals, right, on some of those smaller platforms. So that's, I think, one of the big advantages of KingsCrowd is, rather than you as an investor needing to have 20 different logins across 20 different platforms and checking them all every single week, we look at that for you so that if a deal pops up, you can easily find it in one place on King's Crowd and then check it out.
You should sign up for King's Crowd now, because in the near future, every single company is going to be running them on their own brand and site. They will have major platforms that offer special perks and stuff, but I don't envision a world where people don't have an independent page. And in that case, good luck finding all the best deals. Like, it really will come down to an aggregator, which is kind of ironic because it's 2025 and we're talking about aggregators, but this is one of those very select spaces, securities that it's a big tool. So
yeah, and
great
we're
shout
seeing
out.
that trend more often. These white labeled pages. There's funding platforms and broker dealers that allow you to do that. That is kind of the Dealmaker model, right? Like,
Yeah.
you can't go to Dealmaker and then search among all the active deals. You need to have the link to that specific page or be invited to it. So I agree.
And I think it's the regulation, right, Brian? Like, the regulation stuff is opening up in a way where it like, for a long time, we've talked about this as a marketing, like, it is raising capital, but it's also marketing. Why do I want to market and like leave all of my marketing customers and fans on a platform? And by the way, like, I'm not, putting away with platforms. They're important, but there's a future not far away where, like, the individual asset holder wants their brand out there. They want you to connect with them directly.
All right, Leia. So yeah, you wanted to compare this to one of the other charts that we recently did.
Exactly. On all the charts that we did back in January, we can look at the amount raised on each platform. And what we see here is that Dealmaker deals, the median amount that is raised by issuers on Dealmaker is around $400,000. But what we saw today is that Dealmaker deals are only the second best rated. No, that's not how I should present it. Oh yeah, thank you. What we can see here is that Dealmaker's raise are actually rated overall less. They're not rating as well as Republic, Wefunder, and StartEngine deals, but they are still raising the most. Kind of the same thing for StartEngine, which is also raising a lot of money, twice more. Issuers on StartEngine raised twice more than on Republic and on Wefunder. They raised about $200,000 on StartEngine, $100,000 on Republic, and on Wefunder. That's the median amount raised. But yet, StartEngine raises rate way less than Republic, for example, which is number one in terms of rating. While the ratings are important and shows the overall quality of a deal, investors probably focus on points like maybe the performance. We know that Dealmaker and sometimes StartEngine raises are a little bit more advanced, a little bit more forward into the startup game. They're a bigger company than on other platforms. So that may be one of the reasons. Now, marketing also plays a lot. It could be that raises on Dealmaker, StartEngine just have better marketing strategies than on other platforms. Scott, you seem to have something to say about that.
More money they're spending. I think you just identified it's a direct correlation between two. I don't know much about. I know NetCapital, but I don't have inside information there. Wefunder and Republic spend probably the least amount of money on marketing per deal, per platform, per general portal amongst all of them, but they have the highest rated deals, and yet they come in kind of on the middle amount of money. Suggests that they do their business by trying to bring out fewer but better deals, raise more money per deal, but still collectively less money total than StartEngine and Dealmaker, who spend a lot more money in advertising. StartEngine clearly does through the Mr. Wonderful, more traditional media chains. You'll see them on MSNBC and stuff like that. And Dealmaker, if you subscribe to newsletters, it's like fucking impossible to miss them. They're everywhere. I think that's your correlation.
I think the takeaway from today, obviously, with all of these nuances, just go over, sign up for King's Crowd. We do all of this so that it's nice and easy for you as an investor or as a founder. If you care about all of these nuances between the platforms, we have all of that data, all of that information, just to be able to make more informed decisions for you. So with that, we will sign off. Thank you, Leia and Scott, for your contributions today. Head over to kingscrowd.com, create that account. You can also sign up for our free weekly newsletter where we give you the great data depth deep dives like that chart of the week every single week right to your inbox. You can check that out at pitchreviews.com. We'll see everyone back here next time. Thanks.